The foreign exchange market, or Forex, is actually the largest financial market in the world. It's where currencies are traded, kind of like a global marketplace. Here, money from one country is exchanged for money from another country, and this happens every second of every day. The market never sleeps. It operates 24 hours a day, 5 days a week, across different time zones. Banks, large corporations, and individual traders like you all participate. They buy and sell currencies, you know? The goal is often to make a profit from the changing values of these currencies. It is truly a dynamic and exciting environment. People are drawn to Forex trading for many reasons. One major reason is its high liquidity, which simply means there are always many buyers and sellers in the market. You can easily enter or exit a trade at any time. Another attraction is the potential for profit. The value of currencies is always moving, and these small movements can lead to gains if you make the right trades. Forex trading is also very accessible. You can start with a relatively small amount of capital. All you really need is a computer, an internet connection, and a trading account. This low barrier to entry makes it appealing for many people. The constant fluctuation of currency values is the heart of Forex trading. These changes are caused by many factors. Economic news, such as interest rate decisions from central banks, plays a big role. Political events and global news can also cause big swings in currency prices. For example, if a country's economy is strong, its currency value might go up. Traders try to predict these movements. They analyze charts and news to decide when to buy or sell a currency pair. A currency pair is simply two different currencies, like the euro and the US dollar, or EUR-USD. Understanding currency pairs is fundamental. When you trade Forex, you are always trading one currency against another. For instance, if you buy the EUR-USD pair, you are buying euros and selling US dollars at the same time. You do this because you believe the euro will become stronger compared to the dollar. If your prediction is correct and the euro's value rises, you can sell the pair for a profit. The market offers a wide variety of pairs to trade. This includes major pairs with high trading volumes and more exotic pairs from smaller economies. This variety provides many opportunities for traders. One of the most popular strategies for beginners is trend following. This strategy is based on a simple idea: the trend is your friend. A trend is the general direction the market is moving. It can be an uptrend where prices are generally rising. It can be a downtrend where prices are generally falling, or it can be a sideways trend where prices are moving in a range. A trend-following trader identifies the main trend, then places trades in the same direction. If the market is in an uptrend, they will look for opportunities to buy, and they will hold the trade until the trend shows signs of ending. To follow a trend, traders use tools called technical indicators. Moving averages are a common tool. A moving average smooths out price data to show the underlying trend more clearly. For example, a trader might use a 50-day and a 200-day moving average on their chart. When the shorter-term moving average, the 50-day, crosses above the longer-term one, the 200-day, it can signal the start of a new uptrend. This is often called a golden cross, and it's a signal to consider buying. Conversely, when the 50-day crosses below the 200-day, it's a death cross, signaling a potential downtrend and a time to sell. Another fundamental strategy involves support and resistance levels. Support is a price level where a downtrend is expected to pause due to a concentration of demand. Think of it as a floor that prices have trouble breaking through. Resistance is the opposite. It is a price level where an uptrend is expected to pause due to a concentration of supply, so it acts like a ceiling. Traders identify these levels by looking at historical price charts, searching for points where the price has reversed direction multiple times in the past. These levels can be powerful indicators. Using support and resistance is pretty straightforward. A trader might buy a currency pair when its price falls to a strong support level, expecting the price to bounce back up from that level. On the other hand, they might sell a pair when its price rises to a strong resistance level, expecting the price to be rejected and fall back down. This strategy can be combined with trend following. For example, in an uptrend, a trader might wait for the price to pull back to a support level before buying. This allows them to enter the trend at a better price. One of the biggest mistakes beginners make is trading without a plan. Many new traders jump into the market with excitement and place trades based on emotion or maybe just a random tip. This is really a recipe for disaster. A trading plan is like a roadmap. It should define your goals, your risk tolerance, and the strategies you will use. Your plan should specify exactly what conditions must be met before you enter or exit a trade. It should also include your rules for managing money. Without a plan, your trading will lack discipline, and you will be much more likely to make impulsive and costly decisions. Poor risk management is another common pitfall. Many beginners risk too much capital on a single trade, hoping for a big win that will make them rich quickly. This is a dangerous mindset. In Forex, losses are simply a part of the game. Even the best traders have losing trades. The key is to make sure your losses are small and your wins are bigger. A good rule of thumb is to never risk more than 1 to 2% of your trading account on any single trade. Using a stop-loss order is essential. A stop-loss is an order you place to automatically close your trade if the price moves against you by a certain amount. Overtrading is a mistake driven by impatience and emotion. This happens when a trader places too many trades, often without a valid reason. They might be trying to recover from a loss or feel like they need to be in the market all the time. This leads to taking low-quality trade setups and increases transaction costs. To avoid overtrading, stick to your trading plan. Be patient and wait for high-probability setups that meet all your criteria. It is better to take a few good trades than many bad ones. Remember that sometimes the best trade is no trade at all. Finally, many beginners fail to do their homework. They enter the Forex market without taking the time to learn the basics. They do not understand the factors that move currencies, and they don't practice with a demo account. Forex trading is a skill that takes time and effort to develop. You wouldn't try to fly a plane without lessons, and you should not trade with real money without education. Take the time to read books, watch tutorials, and study the markets. Practice your strategies on a demo account until you can be consistently profitable before you risk your own money. If you are ready to start your journey into Forex trading, the first step is education. Immerse yourself in learning. There are just so many resources available. Read books from experienced traders, follow reputable financial news websites, and watch educational videos and webinars. Focus on understanding the fundamentals first. Learn about economic indicators like GDP, inflation, and employment data. Understand how central bank policies affect currency values. The more you know, the more confident you will be in your trading decisions. A solid educational foundation is not optional. It is essential for long-term success. Once you have a good grasp of the basics, open a demo account. A demo account is a practice account offered by most Forex brokers, and it allows you to trade with virtual money in a real market environment. This is an invaluable tool for beginners. You can test your trading strategies without risking any real capital. Use the demo account to get comfortable with your trading platform. Practice placing orders, setting stop losses, and managing your trades. Keep a journal of your demo trades and analyze what worked and what did not. Only when you have a proven profitable strategy on a demo account should you consider trading with real money. Choosing the right broker is a critical step. Your broker is your partner in trading, so you need one that is reliable and trustworthy. Look for brokers that are regulated by a major financial authority. Regulation provides a layer of protection for your funds. Compare brokers based on factors like spreads, the cost of trading, the trading platforms they offer, and the quality of their customer support. Read reviews and see what other traders are saying. Do not rush this decision. A good broker will provide a smooth trading experience, while a bad one can cause a lot of frustration and problems. Finally, start small and be patient. When you do decide to trade with real money, begin with a small account and risk only what you can afford to lose. This will help you manage the emotional side of trading, because it is very different when real money is on the line. Your goal in the beginning is not to get rich quick. Your goal is to survive and learn. Focus on executing your trading plan flawlessly. Be patient with your progress. Forex trading is a marathon, not a sprint. With discipline, continuous learning, and proper risk management, you can build the skills to become a successful trader over time.